Hello and welcome back to the Note. We've had an exciting week on Wall Street. That's largely thanks to the Fed meeting on Wednesday and the reaction to it. But at the end of the week, not an awful lot has changed. The one big significant development we're showing you here, and that is that the seemingly unstoppable rise of the dollar has stopped, at least for now. Plainly a very sharp reversal today and for the week as a whole. Not yet enough to say that we have clearly reversed trend. The dollar remains much stronger than it was even a few weeks ago and much stronger than many people expected it to be. But plainly the Fed's insistence that it wanted to make clear that it wasn't necessarily raising rates in a hurry, that it was trying to emphasize the slow pace at which rates will rise when they do begin to rise, has managed to make people reconsider exactly how confident they are about their dollar bets. From now on, it will all be about data dependency, watching the data as it comes in and trying to gauge how that will affect the Fed's thinking. Now, the dollar still tends to have a big effect on the way other asset classes around the world are perceived. There's been a lot of excitement this week in the UK about the FTSE 100 passing the 7,000 barrier for the first time. I'd like to suggest that really there should be a little more excitement about China rather than the UK. This is how the FTSE has done over the last year. In dollar terms, you can see that the depreciation of sterling more than cancels out anything exciting that's happening in the local stock market. But when you look at the Shanghai Composite in China, which has been on fire again this week thanks to continued loosening measures by the authorities there, plainly something is going on. Whether it's a positive sign that local investors are getting excited, or rather a negative sign that there is nothing else interesting for them to invest in, and so they are diving for the ever bubbly and erratic Chinese stock market. We'll need to find that one out, but something is going on in China which needs to be monitored. As for the week ahead, as we need to be data dependent these days, well, there will be a fair few interesting data prints. We get inflation data out of the US and the UK on Tuesday, followed by Japan on Wednesday. We get US GDP growth figures on Friday, along with Michigan consumer sentiment. All of those might yet upset the apple cart, depending on what we find. Perhaps the action, though, could most decisively move over to emerging markets. Central banks are very important actors at the moment. We hear from 7 of them in the emerging markets on their monetary policy next week. How many will feel the need to continue the process, maybe you could even call it the currency war, of cutting rates? That's perhaps the most interesting development to look forward to next week. This week belongs to the Fed.